In this video, we're going to talk about options. Now, when most people talk about options, they think about trading stock options. And stock options are pretty easy to trade on most trading platforms today. I'm actually going to do something a little bit different. I'm going to talk about options in a little bit broader context because there's a very fundamental idea going on behind options. Options are something you come across in business all the time. So if you understand this idea, it can be very powerful. So let's start by talking about what an option is. An option is a financial contract that gives the holder the right to buy or sell something at a specific price by a specific date at some point in the future. So if you were to buy a stock option, what that's doing is it's giving you the right to buy or sell stock at a specific price by a specific date in the future. So you're not actually buying the stock. What you're doing is you're buying the right to buy the stock. So here's the very fundamental question that we're asking here. And the question is, how do we value the right to enter into a transaction? So we're not actually making the purchase, we're not actually entering into the transaction, we're just buying the right to enter into a transaction. So how do we value that? It's clearly not going to be as valuable as the actual transaction. It's going to be some amount less than that, but how much less? And that's a very interesting question. So let's talk about options to give you a little bit broader perspective, because as I mentioned, you run across options all the time in business. And let me give you a couple of examples. So if you're in real estate, you might have the option to buy a piece of land. You might have a contract where you purchase the right to purchase some land. You're not actually purchasing the land, you just want the option to purchase the land. Another example might be an option to extend a service contract. So you might have a service contract with a vendor for 1 year. And in that contract, you might have the option to extend that contract for another year. So rather than purchasing a 2-year contract, you just have a 1-year contract, but you have the option to extend that contract. And another good example of options would be the film industry. So in the film industry, if you were going to make a movie, you would set up all these contracts, namely with the writer and the actors. And you would set up a contract for a movie, but within that contract you might have an option to make a sequel. So if you're going to make the sequel, you obviously want the actors to come back and be in the sequel, but you don't actually want to pay everybody up front for 2 movies. So you're going to have the option to make movie 2. You're going to write the contracts for movie 1, but you're going to have the option, if you want, to make movie 2. So, why do we use these options? What's the benefit that's being created here? And there's actually a lot of value to using options. And what we're doing is an option delays the decision to enter into a transaction. And what this does is it reduces your risk and unlocks your capital. So let's go back to the movie example. What you're doing is you're delaying the decision to make movie 2. You're going to make movie 1, but you obviously want to wait to decide on whether to spend the money on to make movie 2 until you see how movie 1 performs at the box office. And if it performs well and makes a lot of money, then you're going to make movie 2. But what you're doing with an option is you're delaying the decision to make movie 2. And what that does is it unlocks all this capital. So rather than paying for 2 movies up front, you're only paying for 1 movie, and all that other capital is free to use in your business or to use in other financing activities. So if you look at your business model and you can create these options to delay decisions until you have better information, you're delaying decisions to spend money, and this reduces your risk and unlocks capital. And that's what options are all about. And what's interesting is this is the same way that insurance works. So let's think about insurance for a moment, because what you do with insurance is you pay a small amount every month for the right to collect a payout in the event that some specific event happens in the future. And if that event happens, you receive the payout. That's the same way that options work. And I mean, let's just consider if insurance didn't work this way. I mean, imagine if you had to hold all the money for the payout up front. So let's use car insurance, for example. Let's say you bought a car and you were required to put into a bank account, when you make that purchase, enough money to cover the event of an accident. So you wouldn't only have to pay for the car, you would have to put into a bank account the replacement value for your car and the replacement value for whatever car you hit. That's what we would have to do if we didn't have insurance. And it would be horrible. None of us would be able to afford cars. But by structuring insurance in the way where you make this small monthly payment for this payout in the future if a certain event happens, what you're doing is you're distributing risk across society. And that's the same thing we see with options. So let's bring this back to stock options. And when you use a stock option, what you're doing is you're delaying this decision to actually purchase the stock. So you're going to make this small payment up front, and this will give you the right to enter into a transaction down the line at a set price. And then what you can do is you can watch the market movements. And as the market movements go along, if it makes sense in the future, then you can go ahead and make that stock purchase when you have more information. And what this does is it reduces your risk and unlocks this capital that you would have spent if you bought all that stock up front. So I hope you enjoyed this kind of overview discussion about options. And this does leave a simple matter to discuss, which is how do we value this right? How do we value the right to enter into a transaction? And that's what we're going to talk about in the next video, where we're going to talk about the Black-Scholes pricing model. And this is a mathematical equation that helps us value options.